So far, the Nasdaq's January loss of more than 7% is bigger than the loss it has posted for any full year since 2008. Joining me now is Chris Grisanti. He's the chief equity strategist and senior portfolio manager at MAI Capital Management. You love declines, Chris. You want to get in there, pick up some stocks. You've been waiting to scoop up. No. What do you make of this environment, and what names are attractive to you?
Well, thanks. First of all, Kelly, it's nice to be back with you. Second, we do love some declines, and this one we don't mind at all because the headlines are that technology stocks are down because interest rates are up. And, I get the academic argument, which is that, future cash flows are worth less if they're discounted with a higher interest rate. I don't think anybody who's selling those stocks are doing that math. I think what's happening is folks made an awful lot of money on these names. They're not particularly cheap on current earnings, but boy, if you look out a year or two and you believe those earnings are going to be there, they're terrific buys right now. For example, if you want to stick to the FAANGs, Amazon would be our favorite. It has done basically nothing for an entire year with a strongly up market. And that's because it's reinvested a lot of its earnings last year. This year coming up, it will return some of that cash flow in the form of profits. When it has done that in the past, the stock has acted very well. So we like Amazon's probably our favorite FAANG stock this year.
You also like Facebook. You also like Google. Is there any reason Apple and Netflix aren't listed here?
Great companies. Just a little too expensive by our metrics. Apple, which is trading, near 30 times earnings. We still remember when it was trading at 11 times, maybe 4 years ago, when it was just an iPhone company. It's a lot more than an iPhone company now, but the predominant amount of its profits do come from hardware. So, I'm just a little more scared of multiple inflation at Apple than I would be, say, at Google or Facebook, which are growing their earnings stronger and have less reliance on hardware.
Would there be anywhere else in tech you'd be sniffing around with some of the stocks where we've seen more than 50% declines?
Sure. I think it's nice time to come up with a shopping list. We actually are doing work we haven't bought it yet. We've done a lot of work on Netflix, which is trading near the bottom of its historical valuation. So they just raised prices a couple of days ago. There's a big earnings report out tomorrow. We're going to wait and see what that looks like. But that's another one that's at least worth investigating. It's time for investors to look at those things that are trading near the bottom of their historical range. And there's more and more stocks in technology that are coming into that category.
I mean, there's also names like Etsy, which are down 25% just in the past 2.5 weeks. What do you make of those kinds of moves?
Well, I would ask your viewers to be careful because while a stock might be down a lot, Etsy may be a good example. Tesla would be another one. They went up so much prior to that look at the absolute valuation, not just the percentage that it's down. I mentioned Netflix because on an EV to EBITDA basis, it's actually cheap compared to where it usually is. I think if you looked at Tesla or Etsy, you might get a slightly different story. But do the homework and then feel confident if it's at an absolute historical low to at least start to wade in here, I think.
And finally, I don't know if you want to do a little victory lap on Activision, which you did like. Yeah. I think when we talked November or December timeframe, although I don't know how much of a victory lap because the stock is actually not doing that well. It's still 13 bucks below the price.
Thing. Yeah. Sure. So, we got that all right. We were buying it heavily in November and December, as I talked about on the show. Now, of course, it's not a huge victory lap because 6 months ago, the stock was at 100 before all the sexual harassment allegations and things like that. But we did invest heavily when it was down low. This is a real regulatory challenge, and it's going to take the better part of a year and a half to see it through. So the big spread is probably somewhat appropriate, and we're weighing our options about what to do here.
All right. We will leave it there. Come back soon, Chris. We'll check back in then. Thank you so much for your time.
Good to be with you, Kelly.
Chris Grisanti with MAI Capital Management.